he's grilling or cooking or whatever, burning an entire goat head on the grill.
Oh my Lord.
They had an offer that was similar to ours, but they said, don't show this to your lawyer, though. And it was like, okay, this is kind of
No, I don't like this.
crazy. Yeah, I'm going to arbitrage this money because, of course, that HELOC rate at the time was 2.25. I don't know how they would. It smelled so bad of dog pee and cat. Oh, it was awful.
Yeah.
I was like, how are you going to rent this out without doing anything like that?
You have to do something.
And 2 offers came in at $5.5 million. And we came to table, we were like, they literally bought it for cash.
Yeah.
They didn't have a loan. And I was just like,
Welcome back to the Investor Unite podcast, where we talk all things real estate, business, and entrepreneurship.
If you are looking to ignite your real estate investing, then join us at Investors Unite. And on today's podcast, we have a very experienced guest and who also just hit 25-year anniversary. So congratulations to that.
thank you. Thank you.
But Jeff Allen. So welcome.
Yeah,
We
appreciate you coming on.
Yep.
Thank you very much for having me today.
Of course. I'm very excited to dive into, your backstory as we always do, but you kind of have like a special niche. We'll dive into it a little bit, but syndications and, just diversifying your portfolio a little bit. So I'd love to teach the audience, what you know and hopefully guide them in some kind of direction.
Yeah.
Sure.
And also talk about that big deal you've done, netting $2.5 million, your company netting that, which is
That's
completely
outrageous.
insane just from one deal.
Yeah.
So I would love to talk about that as well. But first and foremost, how did you get started? Did you have a mentor coming into the business? How did it come about?
Yeah, so I only got started 4 years ago.
Are you serious?
No
That's
way.
it.
Oh, I didn't know this.
I was just, I've just been a W-2 employee. I'm a structural engineer.
Yep.
And so now I like to say by day I'm a structural engineer. By night, I'm an alternative asset investor.
Do you still work as a
Yep.
structural engineer?
Yeah, it's still a
No way.
full-time job.
That's
So
awesome.
Wow.
still working towards, just
Financial freedom at some point.
financial freedom. Absolutely.
You're almost there.
And some would say with you, just netting 2.5 on one deal.
Invest that correctly and you're good to go.
Yeah, you could have.
Well, if it was all mine, that would be different story.
Yeah.
Yeah, break it up.
Yeah.
Taxes too.
And we'll get into
Yeah.
it all. Yeah.
So 4 years ago, we were in 2020, right? So
Right.
beginning of pandemic.
It was just before, the end of 2019. I was just starting to look into, real estate. What is it? I'd heard some things. I hadn't even read Rich Dad, Poor Dad at that point.
Yeah.
Of course, kind of the journey start for everybody.
Everybody.
Talking to, a fellow church member that was living out of state. He had doing a couple things. And then my one friend, who's turned out to be my business partner, who was also the best man at my wedding, he had some single family houses and he did some flipping but some buy and hold. So I was like, start to ask him a few questions, right? And I was like, okay, well, we'll maybe go on this journey. And actually, when I was talking to him about this, his wife is a dental hygienist. Somebody was in there and said, hey, there's this apartment complex for sale. And, would Trent be interested? He's like, hey, do you want to buy? I was like, man, that'd be like, I haven't bought anything yet.
Yeah.
That's a great way to jump into it.
Yeah, and it turned out it was the deal we eventually got. But
Your first deal.
it wasn't the first deal because we three of us from church were originally going in together and looking at this, and but they said, a broker came in at the last minute. We had a verbal agreement. We hadn't signed all the paperwork. So a couple days later, they backed out because it was kind of a unique situation. But that was like a Wednesday, and then Friday, Saturday, the world shut down, basically, right?
Yeah.
So
you're
it's like,
right
all right,
there.
it was the Lord's will. We're not going to get this now. Nobody knew what was going to happen, right?
Exactly.
So it's like, all right,
Could have been a blessing that you didn't.
Correct. Yeah, absolutely. So I was researching, and then I, bought my first house off the MLS then, but I used some tactics with the broker. We did an escalation clause and some of those things. And I did a cash offer because I was going to use funds from a HELOC that I would secured right before, as the pandemic was starting and things.
Gotcha.
And, use it for a down payment instead of, we weren't really going to do all cash. But,
So you sound pretty knowledgeable already, jumping into it. How many years or how long would you say, you studied this for?
So probably 4 to 6 months, but I listen to podcasts at times 2 speed. So
Yo, I do the same thing.
That's her.
I listened to hundreds and hundreds of hours of podcasts.
Yeah.
I read books, and looked into those type of
Yeah, that's the
things.
best way to just learn so fast. I told him to do it. He was like, I can't handle it.
I swear. So I listen to podcasts every single day while I'm at work. Like I just drive a forklift around. I set my phone down. And I just have my AirPods in. So I can listen to like pretty much 8 hours of podcast. I'm getting like 4 to 5 like solid, hour-long podcasts per day. And she keeps telling me, like, move it to 2 speed. And she sent me this one, and she was like, put it on 1.75. I was like, all right, I'll try it. Dude, I tell you, I'm like 20 minutes in this podcast. I was like, I didn't comprehend a damn thing. I was like, I'll have to go back and re-listen to all this again. I was like, I don't know, just the normal speed. Like
You have to train.
It resonates with
train
me.
your mind.
I do.
And so now, I say, I talk fast. I was like, I might have to slow myself down when I listen to it.
Right. No, I'll have to continuously train that. It's definitely a muscle to build.
Start at 1.25, right?
Yeah,
I'll start there. Something a little bit
Then
extra.
go to 1.5.
Right.
Right.
Yeah, so it wasn't just like overnight, there is, when I look back, I was like, oh, there really is hundreds of hours of studying. And being a detailed person, a structural engineer, I'm
pay
into the
attention to
details.
every little thing.
Right. So that's how, I say my first one, I thought it was like a bunt single that's now turned into a stolen second base, but that's kind of everything with real estate. If you even if you
Hopefully.
don't buy it right, but you buy it good,
Right.
things will
Eventually,
tend to,
in the long run, it will play out.
Right.
Exactly.
Do you still own that one too?
I
this
do.
day?
Yep.
Wow.
I'm surprised being a structural engineer, you kind of didn't jump into like the development side first, I
Yeah.
feel like that almost correlates a little bit.
I guess so, and we would have different things. Whether you mean as far as like developing a complex or something.
Complex, single family, I mean, whatever you would be comfortable with based off your career.
Yeah. There is some similarities here and there, but
I'm not too familiar with structural engineer. Like I have an idea in my head, but it's probably, so wrong. I don't know. So you went ahead and, pandemic hit, broker got involved, wacky deals going on.
Yeah.
So what ended up like, how did that proceed?
It basically, he said they kept us. They were putting it on the market, and that was gonna, they were gonna try to sell it.
Sure.
But they kept a clause like, hey, if it ever comes back to us, they'll keep it open. So in the meantime, this is where I found the single family townhouse.
Gotcha.
And was able to implement those strategies from the MLS and get that and.
Yeah.
Original tenant's still there.
That's awesome. So that was just a very like traditional just purchase. Now, you paid straight cash for it?
I didn't. I said it was going to be a cash offer.
Yeah.
So that there was no financing contingencies, but I did get financing. So I just put a 25% down payment
Using
on it,
your HELOC.
using my HELOC,
Okay.
right?
Gotcha.
And then ran through the numbers for the cash flow and things. So like.
Typical conventional?
Yes.
loan?
Yep.
Gotcha. Okay.
And it was like 3.75 because the
that's
rates were still
Can't beat
great
that.
then, right?
Can't beat that.
That's so 30-year fixed.
Now, what's crazy, so we have now, since then, over doubled the interest rate. Has your property gone up in value since then?
Oh, absolutely.
Absolutely.
Yeah.
Isn't that crazy? Like,
It is.
Even though the monthly payment has increased so substantially, it's the value of the property, there's still a high demand for it. So that's going to continue to hold and even appreciate, year over year.
Right. And that property would have escalated through the pandemic kind of time where everything was constrained and housing prices just went crazy too.
Yeah.
It was insane.
So what was it worth when you bought it? What did you pay for it?
127.5, I think.
Okay.
And what do you think it's worth now?
Now it's probably 175.
There you go.
Yeah.
Yeah, just in a couple of years.
Stocks
Crazy.
couldn't do that one.
No. Right, because you're getting cash flow, you're getting mortgage pay down,
Tax write-offs.
Tax write-off, exactly.
Exactly.
So how did the next deal come about after you did that one?
So as we were going through, then the original guys that through this other property came back to us and said, "Hey, we've had people walk this, and there's really from our area a couple large names of people that you guys would know walk that property
Probably some that we've had on here.
potentially, and
Yeah.
that it's like, well, it wasn't for them or something. So they came back to us and said, "Hey, are you guys still interested?"
Yeah.
And then we said, "Yeah, we are." Now the one gentleman in our church was had moved on to some other things. He has some buy and hold and was doing stuff with his son. So it was just.
It's strange that they were still trying to offer it to other people versus coming back to somebody who they knew was already interested.
Well, so the broker put it. The commercial broker realty is it's so different than it is the MLS, right? It's all the pocket listings, and they have their people, and they're like, hey, I'm going to call these people, come on down and look at it. And this guy happened to be out of the Philly area, so I don't know.
He already had like some rapport built
He
with
probably,
other
and then
investors.
they have investors out of New York that, buy stuff out. And it's cheaper in Pennsylvania, right?
Of course. That's why everybody's coming down here.
Yeah, they had an offer that was similar to ours, but they said, don't show this to your lawyer, though. And I was like, okay, this is kind of
like
crazy. Yeah. So they came back to us and said, yeah, we're still interested. Let's look at the numbers, but probably not for the same price.
Right.
You come back to us.
Yeah, exactly.
So we had a verbal agreement at $3.5 million. Came back, and I had read Chris's boss's book, Never Split the Difference.
Yes.
So we were using the tactics, and I'm like, 3.355, 679.
A random number.
Very specific though, but we got it under
property qualifies for. So.
Yeah, we got under contract with them then in writing, for $3.4 million. So I like to say we negotiated off of like a single family house off of that.
You got
property.
$100K off of it, so it's a good deal.
And how many units is it?
52 unit.
52
wow,
units.
what area?
Hummelstown.
That's a fantastic area.
Yeah, it was right next to a huge development with like $750,000 houses
There you
and
go.
things. So
That's
we were
awesome.
kind of on a dead end road right by Swatara Creek.
Perfect. There you go.
And what was it initially priced at? Where were they?
What are they trying to sell it for?
I think when we initially talked to us, they were somewhere in the 4.2, maybe 4,
So you
as
got
high as 4.5.
A good discount then.
But yeah, I mean, so there'd been previous owners, that had, and one of them had just run it to the ground. And if I probably said the name, you would know who it is.
Okay.
He's been in other areas. So it had, we'll call it the nice way is deferred maintenance, right?
Yeah, sure.
But, there was a lot of
value add
wrong.
opportunity.
Correct. That was one thing. We looked at the numbers too, and some of the rents hadn't been raised in 4, 5, 6 years.
Wow.
So there's a lot of loss to lease things going, opportunity there to make up some income from that as well.
Of course. And then with doing that, I mean, increasing those rents, does that increase the value of the property then as well?
Absolutely. So just for instance on this, we knew we were going to renovate the units too and bring them up. So, but over the course of the time we owned the property, we didn't. We let about 3 to 4 months in. We waited till we got things, kind of going, and we were kind of running smoothly. Sort of, it was stabilized because there was people in there, except for the units we were turning, but or renovating, I guess.
Yeah.
But we ended up probably about 30 to 33, 35 units that we raised the rent, and we started with the 4, 5, 6 year, right? You haven't had your rent raised in a while. Sorry, it's not going to be a $50. It was the average ended up being about 112. So some of them would have been, if they're 2 bedrooms, we could get them to 900 in that area.
Yeah.
They were at 7, 7.25, 750, 675.
Wow.
So we were able to do the first batch of 20 some, and then later we waited another 4 or 5 months and did a second batch. So in all, we ended up. So if you make the numbers easy, $100 a unit, right?
Sure.
30 units. So that's.
Was that 3,000?
3,000.
3,000 a month. Yeah. To make it I was trying to make it easy, right? 3,000 a month. So for the year, that's 36,000, right?
Right.
So that's just in generated cash flow. So I mean that's really good.
Yeah.
But then if you look at a cap rate, and we're getting into some things that people might have to look up or whatever, we don't explain everything.
Explain it to them.
Yeah. Cap rate's a little bit hard to explain, but basically you take whatever the cap rate is, which they were compressing, and you divide by the cap rate. So when you divide by the lower number, it gives you a higher increase. So when you are bringing in more revenue and you're dividing by a smaller number, basically it creates 850,000. If you're saying a 5 cap, we were kind of lower than that, but being conservative. So you take 36,000 divided by.
How did you determine your cap rate in that area?
Well, we bought it. I was looking at the numbers, and we bought it for an 8+ cap rate. But once again, it's hard. You can talk to different people and come up
varies a lot
with things. And really, the cap rate is just if you're trying to compare different assets in different areas. What's this gonna how can my money be used effectively and things. So,
Okay.
But yeah, I mean, right there, just raising rents because they haven't been done. I mean, it was, $850,000 worth of value to, in the end. Right.
Without even touching the property, really.
Correct. Yeah.
That's awesome.
Just implementing a strategy.
Did you have to go through any evictions during this process?
Through the time we had it, we really didn't have to. We had one that we asked to leave because it was just kind of more of a hoarding situation.
Gotcha.
And, they left on their own.
That's good.
But yeah, so when you go high level, things sound great, but when you get, as you two know, when you get into the weeds sometimes,
it can get a little
you
messy.
have to deal with stuff and, a business partner going over at 7:30 at night on a Friday night or something because water's coming down through the ceiling.
He just came from a property.
Just had that.
Yeah.
And you get here's another funny story. Just things happen, right? So we got this. We had property management companies walk the property, and we selected one that we could work with because we wanted to take on a lot of the responsibility. Right. My business partner, he's runs the facility. He's a facilities manager at our church and school. But he had to cut his own handyman business. So with partnering, we partnered well because I was great with numbers and spreadsheets. And
he was more of the physical labor aspect.
He is. And he's got a vision for the design. And I can change a toilet flapper. And I'm excited. Yay! I did it. And he could just win. And he's like, oh, just do this. And I always call him, like, if I have an issue at home, I just call him up. Hey, I can't get this. I said, I tried that. Yeah. Let me do it again. And if he's on the phone, the magic just
somehow works. Oh, my gosh, yeah.
So we were a good party, and he would spend 2 days a week there, and I was working at nights to crunching things and everything. But we did, I did the demo work.
That's awesome.
But we would get these, when the tenants will call in, or they use the system for all these problems that they would have and things. So we try to solve that, and eventually we pushed more and more onto the property management company.
Okay.
Because we were like, oh, I want you working on the high dollar, high value. We learned that process, right? We bring a painter in for $20 an hour to paint. Yeah. You don't need to be painting.
Just value your time.
That's right. You do the $500 an hour jobs.
Exactly.
But we get this one, this smell, it's stinking over here, and it's like, okay. Well, he was over there with his son the one day. He's like, oh, God, let me go see what's going on. I'll ask this guy who's back over here grilling. Oh, have you smelled this? And let's try to maybe troubleshoot and figure it out. So he's walking over, and he gets to the grill, and the guy opens up, and he's grilling or cooking or whatever, burning an entire goat head on the grill.
Oh, my Lord.
And he was like, listen, sir, I don't know, I understand you got some things.
Is this legal?
Not be burning this goat head with hair. It's going to smell and all this. You can't do that.
Hair stinks so bad when it's burnt.
It's going to be an issue. I understand there's some things, but you got to do this at a butcher shop or something.
That's crazy.
So there's stuff like that is funny now,
I can't say
but then you got to deal with it.
Yeah, I don't want to deal with that.
I hope not.
That is something.
But, so you said when purchasing this property, one of the initial three had backed out because he went on to doing other stuff, right?
Yeah, he was in with his son, and he was flipping property and renovating. He had a buy and hold portfolio as well. Yeah.
Okay. So with just the two of you, how did you come up with the capital needed?
Very good
to
question.
Go ahead and purchase this?
We didn't buy ourselves. So that's a good question. So I had still some HELOC money as well, and
just from your primary.
Yeah, because I was basically using and trying to figure out, hey, I'm going to arbitrage this money because, of course, that HELOC rate at the time was 2.25. So I was actually making short-term investments too, at 6% a month, or 6% for annualized, but coming back monthly just to arbitrage that. So we needed to. I figured to do this, we needed to raise $850,000.
Okay.
So we had to go out to family and friends and kind of raise some money then because we weren't going to be able to come up with all that money on our own by ourselves.
And what's your pitch to them? If you were to pitch us right now,
spreadsheet of
So being the guy, I had a spreadsheet, right? But then I put a PowerPoint presentation together.
There you go.
And I sent it off, but just in talking to him and things too, it's and then what we did, because we didn't have a track record. More so, it was your first level, right? Everybody knows who we are. We are a business partner, so it's like basically they're putting their faith in us.
Right.
They know what we're going to do. The faith they're putting their confidence in us, essentially, because they don't know a lot about real estate, but and I had shown, okay, here's the plan. This is what we're going to do.
Trying to teach them cap rate and everything.
Yeah,
we don't.
Yeah, we didn't. You don't go. Yeah, and in the setup of the structure, I'm not going to set up waterfalls and this and that. It's going to be simple. Okay, you give us like 100,000, you're going to get 8%, right? Okay, and that's equity in the LLC that we're created, right? So it's simple that when we do a distribution. If it's quarterly, if it's a $10,000 distribution, you're going to get 8%. You're getting $800 or something like that.
Right.
So I kept things pretty simplistic that way, because even though I can understand that there's these complicated things you can do, this is our first deal, big deal.
Try to make it as simple as possible.
Going from 1 unit to 52 units is our second purchase.
That's a big gap.
Yeah, definitely. So that's how we would have and explain, and then when you have some knowledge, you say, okay, what about this? And then I like that they would ask questions, because then it's like it's a good question. Here's what and
then
then
show your level of knowledge to them, and like how comfortable that they could be with you.
Correct.
Going into this kind of transaction.
Yeah, and then you're looking at worst case scenario. So I did a stress test on it and said, okay, we have to be, and it was all the way down. If assuming we were buying it, it was going to be in low to mid 60s of occupancy that that was coming in, and we could still pay all the bills, pay the mortgage, and all that kind of stuff too.
This thing is probably a cash cow then.
It was pretty good, but we were throwing all that money back into it. So I had some reserve for capital expenditures, but I knew we were going to take, of all the money coming in, we were going to save up, distribute, 5%, roughly a 5.5% the first year as far as an annualized return. So a lot of that money was going to go back into, I had planned that, because I didn't, looking back, I probably should have raised more in capital expense just to renovate and do those things, but I didn't know. Yeah, well, and we were a slower pace. We were kind of doing things ourselves, and we started doing, other things. And we were trying to spend money fiscally responsibly. For instance, then, like it's 13 buildings made up of 4 units in each building. Okay. And in my PowerPoint where I present this sometimes, I'll show you before and after pictures. Yeah. You have this green carpet you can imagine in the stairwell, or a yellow mustard. One was like a flower poinsettia thing. I don't know. Yeah. Jeez. And then we had Touch of Color flooring come in. It was like 3.5 days. They had like 12 of the buildings, ripped out all that carpet, put in luxury vinyl plank, outdoor carpeting. It just elevated everything. As soon as the resident tenant comes in, they're like, oh, wow, this looks nice.
You think about how much smell that carpet's gathered over the years, too.
Probably, yeah.
Yep. Now, for people that, want to invest, let's say, for this type of deal, I know with syndications, there's like accredited investors and non-accredited. So like in your case, the people, your family members, did they have to be accredited?
Yeah. So, and I didn't even have as much knowledge then as I did now. So theoretically, the way we would probably set it up and the way I would call it now was a joint venture. Yeah. Right. In that, so we didn't actually do any SEC filing. So for syndications, what you'll typically do is you'll do an SEC filing, and then they'll call it a Regulation B or C, right? And so they do that. And so those are actually exemptions that the SEC allows you for the invest. So that's why you have to be an accredited investor for the C. So then you can get around certain things. And then for the B, you obviously can't advertise openly, but you can take non-accredited investors as well, up to 35.
And to be accredited, there's 2 things that you have to do to qualify, correct? Where it's like
there's actually a big list.
Okay,
but
I know of like
it's like a network.
Yes, but typically, there are 2 ways that most people. But there is more. You could get your Series 7 and be an accredited investor. There's tests. There's some other things you can do. Yeah. But the 2 ways you're talking about is either if you're a single, you make $200,000 a year and expect to make it. If you're married, it's actually I think $300,000.
Yeah, it's a little bit higher.
Yeah. And then, or your net worth is $1 million, not including your primary, home, primary resident. Gotcha. Yeah, okay. Yeah, that's the 2 that everybody talks about. Right. There is some.
I'm sure there's a bunch more. Yeah, I don't know about all those yet. I'll get there one day.
But we set up an LLC to be able to purchase this, and then so essentially then our investors would have, they call it, and I put it in air quotes, right?
Yeah.
A vested, not a vested interest, but I forget the exact terminology that they use, but like kind of have some input on things. So
Gotcha.
So it was all laid out basically in the operating agreement where this person has this percentage, this person has this percentage, but also has a say when it comes to sell the property or...
No, they didn't have any say. No, we had an operating agreement. It was me and my business partner. We had all the say. Now, did we ask them? Yeah, and
of course.
Things like that. But we had certain things in the operating agreement because you want to go in up front, and let people know, what type of say. So
this is what you can expect.
Yeah, absolutely.
Okay.
Now, with that raising of the $800,000 and the property was worth 3.4, you said you guys went under contract for. So that difference, did you and your partner come to the table with that, or like did you get a bank loan to finance the rest of that?
Right. Yeah, we were going to get a lender to finance that for us, and originally we were looking at doing a thing called a swap loan with the bank, and we were trying to do it. If you recall back 4 years ago, kind of same time we are now, there was an election coming up. Yeah. We were trying to get things done before the election. It never happened, just with paperwork and things. But
it always gets delayed.
We were looking at in a swap loan. It's very hard to. It's complicated, but somebody can look that up too.
Okay.
But basically, you're locked in, and people are kind of invested. A thing where if rates go up, our rate's going to stay the same, because of things. But if you're at a higher rate and rates go down, you can't really easily finance out of it because there'll be penalties and things too.
Gotcha.
But we were at the lowest interest rate ever, so we're like, well, there really isn't an issue here.
Yeah.
Problem was, COVID changed a lot of things because we're now into 2021 when we're trying to finalize and close this in the early January, February, trying to close in our early spring.
Yeah.
So banks were changing their policies. There were things like, we called it like the COVID tax, but they wanted to anywhere from 6 to 18 months worth of principal and interest up front.
Wow.
Yep.
So on a deal this size, that was like another $250,000.
That's a lot.
Exactly.
And it was like, I don't know, what we're going to do. They don't have that just to sit in an account for, and then after a year you can request it back.
Yep.
That's a lot of. So we had to pivot from a Fannie Mae or Freddie Mac small balance loan. We were looking to get $2.7 million basically from that would be with 20% down. If we had to do 25% down. It would be a little different. So we were originally looking at 20. And so we had to pivot to a local bank. And we reached out to a few lenders and had some favorable discussions with it then. Now, these were then going to be recourse loans versus a non-recourse loan. We originally went non-recourse. And non-recourse means that you're personally not liable for it, but everything is on that property, right?
Right.
So the recourse loan means, hey, if the property goes and they sell it and you're still they're going to come after me, right? Oh, okay. And my business partner as a recourse, like, hey, we're going to get our money back from you guys. So we basically, in going this route, we're going to have to say, hey, we're going to pay this back no matter what, kind of.
Yeah.
So you talk to the one bank, they had pretty good rates. They both did, and we were kind of figuring out. One of them wanted to set aside like $100,000 in a kind of capital expenditure account
for reserves.
As reserves, and when we spend it, then we would do a draw from that. And the other one, was going to let us do what we wanted. So that was kind of the draw, not to go that way. Yeah. But their fees were a little high on this other one, so I was like, hey, and we're talking with the first bank, I was bouncing some ideas, and because I got input from a lot of people, calling
the banks
people
against each other
a little bit.
Yeah.
If they're, those
Smart.
people are very generous to you too. If you're nice with them, the brokers are really good. Yeah.
I hope so.
And so we're like, but this fee was like $15,000 with all these different, and it just seemed really high. So I went back and I'm like, listen. Your terms are good. We had a 10-year 3.75 fix with a 25-year AM.
Amazing.
That's perfect.
So it wasn't any of the bridge loan or any of these type of things. We were looking, so it was a long-term loan, and a lot of time commercial loans only go 5 years, and then there's the balloon payment. This was the 10-year, and then you would refinance again or something. Okay. So I was like, hey, this seems a little high. So they ended up, once again, just ask the question, right? I tell people that if you don't ask, you're not get. So they took off think it dropped down to $6,800 was the fee then. So it was like $8,200 or whatever.
That's like 40%.
Yeah, it was like, it's kind of a used car pay.
Tell me
on that negotiation. So we were able to go with that lender, and they were allowing us to do 20% instead of 25%.
Awesome.
It was just on the cusp,
either.
and you didn't need the reserves either.
That's a win-win.
And it sounds great, but when I'm the one signing on it, and I'm guaranteeing that $15,000 a month payment, you've got palpitations in your heart for sure.
Yeah,
but high risk, high reward.
Yeah, and I would say that it technically wasn't that high of a risk in
you
my mind,
had all your
I'd
numbers,
run
like,
the
down to a
numbers,
T.
right? Yeah. But some people, had walked through this too, and I was like, oof. I don't know about this. What are these guys getting themselves into?
Yeah.
Now, did you talk to the previous people that walked it that you said know to see like why didn't they just move forward with it?
We've never talked to them and asked them. We probably could. I think part of it was they were still they were asking too much.
Okay.
As far as a price, and they weren't, willing to, or thought about dropping, or thought about making an offer.
That's true.
That happens a lot. And like, that was one of our main flaws, honestly, when we first started the business. It's like, if we didn't get a number from the seller that we know that we can move forward with, we wouldn't even make the offer sometimes.
Yeah.
And after talking to a bunch of mentors, they're like, no, like, make your offer no matter what. And then using that strategy, coming up with a random number at the end, be like, your property only qualifies for this amount. There's a lot of different techniques that go into it in negotiation, where it's like, you could get some favorable numbers out of it.
Yes.
So that's definitely a good tip to use. I mean, anytime you're going into any one of these small or massive deals,
Right.
Especially large deals. I mean, you could save hundreds of thousands of dollars.
Yes, you can.
Yeah.
And with you guys, purchasing it, how long did it take from, the whole rehab process from start to finish?
So, we were looking at different things, different projects, and kind of what's going to bring the most value for the dollar spent. So I was trying to look at, so if we're renovating units, right? So we were basically, believe me, we needed to rip out the carpeting. And the one unit we didn't get in, like we did our due diligence and we went through every unit, and my business partner must have got through half the buildings that were nicer, and I got the ones too. But one unit we didn't get in, and they moved out before, and we hadn't gotten in. And he said, "You want me to put one in?" We said, "No, we'll renovate that one first."
Right.
Well, I don't know how they would. It smelled so bad of dog pee and cat. It was awful.
Yeah.
I was like, how are you going to rent this out without doing anything like that?
You have to do something.
So we would typically rip all the carpet out, put luxury vinyl plank throughout, rip out the whole kitchen and all the bathroom, and redo everything, And, we did the first few ourselves, and then later on we started rolling in with the property management company to help. And then we would hire, a flooring company to do that,
so
painters to come in. Yes, we would do some of that, because the first one we pretty much did all by ourselves. And when I say I mean mostly my business partner.
Yeah, the labor guy.
But he had that vision, and my kids did a lot of work, and his kids did a lot of work in there too.
Shout out to the kids.
So all in all, we kind of proof of concept, we renovated, 20% of the units. So it was fully 11 or 13. I'd have to check the numbers of that we did. And then there was kind of a soft, someone like already had some partially things, another 4 or 5, So it was almost like there's still now meat on the bone for the next person.
Right.
We weren't necessarily thinking that way. It's kind of the way it happened and turned out then. So, but we knew we had there's trees and limbs, and we had one fall. It's like, all right, we got to cut trees. And it's just not like, this is a $500. Right? No, it's like, this is $15,000 to cut some trees down, because crazy. It's so your mind is expanded from the numbers that is typical for things in that regard.
And for that whole process, would you say it probably took 1 to 2 years, or?
So we actually owned the property for 15 months.
15
in
months?
Total, yeah.
Wow.
Yeah.
Wait, so you guys didn't keep it as a rental? Did you
We did till then, but it's
like
kind
after
of
the fact.
Yeah, it's kind of like part of the rest of the story
right,
too.
Right.
We, and there's things that we were thinking this is, we had a 10-year fixed loan, so we were going to be keeping it,
Right.
and like you said earlier, my daughter, you saw her working over there. Well, we'd go over and we're on a Saturday and we're up cleaning gutters. Right. One story is this guy comes out the back porch and he says, "Oh, are you the maintenance guy?" I'm like, "No, I can't do anything. That guy over there, he's the maintenance guy." He's like, "Well, you got to make your money somehow." And I was thinking to myself, technically, I'm not getting paid to do this right now.
Right.
My kids might have been at the time, but eventually, we'll have a payday in the end. So I had reached out to a broker about another property in Hershey, a 20 unit.
Okay.
And just kind of inquiring at some point, and hey, what's this? And ended up somebody else had gotten it. So he called me back months later, and he knew this property because he had sold it to people before.
Oh, no way.
So when you're talking to brokers, they kind of
small world too.
Relationships and things like that. So he approached us about selling. You ever think about selling? I was like, no.
Yeah.
We're working our process. And
we're happy with what's going on.
Yeah. And I'll tell you, the side note, I write a quarterly check to our investors. Oh man, did that ever feel good?
Yeah.
Because it's like, here you go,
I
here's
told
a
you
check
so.
for and at the first, quarter, it's not much, it's the 5.54% for the year. So
But
they're
it just
getting a
builds
quarter.
that trust.
But it does, but it I don't know, it just made me feel so good to be able to pay them because they trusted in us and we're working the plan.
Exactly.
So we were going through and we bought it for about $66,000 a door.
Okay.
That's really good for Humblestown.
It is. And, it's out. But once again, it was.
I need a lot of work.
You're looking at condition and seeing different things. And, I mean, they didn't have.
See before photos.
Yeah, they didn't have central air or anything. It just had electric baseboard heat. So they units and things. So
you go and put central air in?
We looked at split units for maybe the upper units. We never got to that point.
Yeah,
but
that's expensive.
we threw things around like that. I mean, we weren't at that level. We were like, okay, we got to start making. I mean, we had to rip out 50-year-old carpet to start with.
Yeah, start here.
Put in new stuff,
Right.
And paint. Just paint makes things look good too.
Yeah.
So he's like, gave us this number like, hey, yeah, I can get you whatever, $127,000 a door or something, like a $6.5 million. It was like,
insane.
Listen, we don't need to sell. We don't want to sell, but hey, talk to my business partner, if you can get that, now before we did. So then it was like, okay, we actually reached out to some people and like, hey, we need some advice. Some even locally here, some big name people that's like, hey, you've been doing this for 30 years. What do you think, with the situation? What do you recommend? With COVID, you're going through that. There's still lots of ups and downs. And so there was some wise counsel that we sought with that. And some of it was like, listen, it's not a problem sometimes to take profits off the table. Right? Because you don't know. And we kind of did this hockey stick way up.
Yeah. Oh my gosh, you did
exponential growth.
Really?
And then,
you started here, and then you just went.
Yeah, so over the next 10 years, say, or 9 more years, is it going to be kind of just level and going through? And you don't know that regards. And then we reached out to some people that we used to go to church with that higher income or had their own businesses and things. Or what do you think? So we did a lot of that before it wasn't just a rash decision, right?
Yeah.
So we worked as this broker, and there's obviously details and stories with that, with different things too. But they got to it, and he sees it, and in person. Well, maybe I can't get you quite that much a door because we didn't prove it, but things. But he was kind of still, I think, soft listing it for around 6.5 million, and he just had his people, so I don't know if he thought he could get even more than that or what, but we'd done a lot of things, right? So we created just from raising rents, we create, almost a 7-figure increase, and then when you renovate all those units and we go from 900 to 1050, 11 at the end, 1150 a unit compared to they were getting 725 for that same unit.
Yep.
With the old rent and things. So there's
a big difference.
Those are a lot of differences. I mean, I was telling you about the gutters, we put 4 or 5 new roofs on. There's some other ones we're systematically replacing roofs because they needed to be done.
Yeah.
Gutters and gutter guards. We had to crawl up to the second story and clean the gutters. So those type of things. And so they came back and we had 3 people that made offers, and I think I'd have to recall some of them were in the like high 4, and one was in low 5s.
Yeah.
So it was like, okay, and they went back to like a best and final for these two, and the third guy, he kind of left out, and they called him like, hey, why don't you let us do a best and final? He was like, okay, if you want to. So they came back, and 2 offers came in at $5.5 million.
No way.
Yeah. One of them had no financing contingency on it. It was like, what?
Yeah.
So
Yeah, that's crazy.
it was like, okay.
Especially for a deal of that size.
What was their EMD? Do you remember? Because if they would have backed out, you could
Right. Yeah. I don't remember. It might have been 20,000. I don't think, maybe it was 100. I don't remember now.
Yeah, because that would have been an easy 100K if they backed out.
Yeah. Yeah. Yeah, I don't remember that now. I'd have to look that up, what it actually was. But it turned out, you know, there was a family kind of there. They had started in the 70s. They still owned their first property.
Oh, wow.
Yeah. And multifamily, and the couple of the sons, you know, so conglomerate, they had a couple thousand. Yeah. And the father had did a 1031 exchange from a mobile home park.
Okay.
And had some funds there. And we came to table, you know, we like, they literally bought it for cash.
Yeah.
They didn't have a loan. And I was just like,
That's a lot of money.
okay, you are at another level than what we are.
We're going to need their contact. Bring them on. How did you get here?
Yeah.
All right.
So that was
So when you were going back to your investors with this idea of like, hey, we have this offer on the table, were most of them down for it? Or did some of them want to keep their money invested where they were still getting that monthly return?
when we told them how much, you know, hey, we're going to sell it for this, they were like, okay, sure, go ahead. Yeah. So it turned out for them, they got in 15 months, they got a 2.14 equity multiplier.
Perfect.
Wow.
So if they put in like 100,000 just to make the numbers easy, you know, from the quarterly dividends, and then that they would have got $214,000 back in 15 months.
That's amazing.
You know, so
you don't see that anywhere.
No.
Yeah.
And listen, we did a lot of things right. We worked our plan, but you know, the market wins, or whatever you would say, was favorable to us,
and
right?
the location was amazing too.
Yes, yeah. Like timing of that, what you know, that is out of our control was good. I mean, right now with where we're at, we couldn't do that again unless you somehow got some.
You're talking about on the trying to sell it side?
We're trying to buy now and in 15 months sell.
Right.
I think because of just the market conditions, right? Unless you somehow, you know.
You got to get a killer deal.
Right.
Really low price.
And whereas I think we had a fair deal, you know, they made the sellers had made out pretty good from what they bought it from and those type of things. And it was, you know, it was wearing a headache kind of for things. Like I said, it's not without challenges, you know.
No. So since then, I mean, have you done more deals since that big one?
I'd like to, for sure, right?
Okay.
Yes, I bought I bought another single family property. I used delayed financing on that. So it was an off market deal I found through a broker. And so I essentially paid cash, but I used a private money lender at the beginning, and then some of my own funds. We renovated the one bathroom. It was 4-bedroom, 1 bath in New Cumberland. And so then got a tenant in, but I kept title open.
Gotcha.
So that when I went back to it and said, hey, now I'd go to the lender and say, hey, I want to do the financing on it, because I didn't have, you know, it doesn't have to season for 6 months and those type of things with this delayed financing option. I didn't have to go through title search and everything. Yeah. So it was a lot more cost effective than they'll essentially close a second time because most of all that was still there and done and open. Yeah. So I was able to like get it for 105, you know, put a few thousand into this bathroom, luxury vinyl plank, rip up some carpeting, do some painting, you know, that type of thing. And so it appraised for like 140 some. So, but you can only get 75% of the appraisal, right? But you can only get on delayed financing whatever you put in it. And then so I essentially was there. I still have, you know, a few thousand in that deal, but I essentially get most of it out.
Basically break even.
So it's sort of like a burr as well, too.
So who do you go through for delayed financing? Because it almost sounds like it's like seller financing, but are you going through a bank for this?
Well, so the title company that I use, I told them just to keep it open. I walked in and said, hey, I'm here with because I just came in with the contract.
So where the seller is like...
The seller was a private sale, so we just had our contract made up. There's and I walk in, they're like, okay, what do we do here?
Just leave it.
You know, like they don't have people walking in saying, here's a sale, you know, can you
hold on to this for like 6 months?
But no, they did the title search and all that type of stuff, but they just kept it open then. That was the same broker or whatever title company that we've used for fast, and the broker that I'd talked to, he used them all the time, so they knew that. Nice. So yeah, I don't know if it's a strategy or whatever, but like I said, I used that private money, and then when I got the bank financing, I paid back the private lender then with the, you know, and the percentage that I was paying them too as well.
Now, what would you say is easier, the single family houses or the multi? Because I've been seeing a lot of people on social media, they're saying, oh, the bigger deals are so much easier than the smaller ones. So what would you say?
I would say, how do you define easy, and in what way?
Right. I don't know. I guess like in regards to raising capital, you know, just the whole process of everything.
So let's talk about financing.
Yeah.
If you know how most people, if they buy a house or something, you basically have to give your right arm and paperwork and everything to get financing at lender, right?
Yep.
For commercial property, we provided our net worth, our statements and things, gave the property information. Now, the banks...
Did you provide like a pro forma for that as well?
I showed them. I gave them so much paperwork. I think that's what really helped because they were impressed with the amount of information and kind of like color-coded charts or whatever. I gave them my PowerPoint presentation. I showed them all this, and I think that helped.
Okay.
You're like, wow, we never even get this information, so they're like willing to. So it was like, oh, yeah, here's $2.7 million, no problem. I was like, what? That was so easy. So in that regard,
that was easy.
It's kind of easy for financing compared to
just to be overly prepared.
Yes, correct. Yeah, you just don't walk in with, "Hey, I'm thinking about doing this." No. You make sure you have all your numbers in place.
Yeah. Did you do local banks?
Yes.
Going through?
Yeah, it was actually a credit union that financed the deal for us then too. Yeah.
Awesome. Very cool.
Really. If you're looking at it, a multifamily is just a bigger deal, bigger numbers than a single family.
Right.
Now, so if you have little problems here, you know, you're going to have lots of little problems here.
Right.
So easier, it's hard to say one is easier than the other. I definitely think because of having a partner relationship, we bounced so many ideas off each other. We had phone calls, you know, talking through things, you know, so that's good. Yeah. You know, you're not kind of on an island out there on your own.
Just hoping you make the right decision.
Right. Yep. Yeah. But, you know, as far as that, do you want to jump right into that? And what if you make a mistake? You know, you can recover from $100,000 mistake. Right. It's going to be tough. That's a lot of money.
Yeah.
But how long is it going to take you from $1 million mistake though, too? Right.
3.4 million.
Yeah.
Right.
So, you know, that's kind of the I guess the way I'd look at it. I don't know that one is easier than the other. It could be somewhat of comfortability. Yeah. Because there's some people that don't like to have somebody on top of them or beside them, and then they have to deal with those issues, or like even as an owner dealing with the issues versus if you have a single family house. Okay. They're there and they take care of things on their own.
So you prefer multi then?
Oh, yeah. Now I
do. We do too. Yeah. So we've done a handful of both, and it's multifamily is just the way to go. Yeah. Especially when it comes to actually holding on to a rental property.
Right.
It's like one of the, you know, there's so many different arguments against it, but the main one that sticks out to me is you have a unit go vacant, you're still generating income.
Yes.
If you have a single family go vacant, you're paying out of pocket for the entire property.
Yeah.
Right. So that's,
part of it's the economy of scale, right?
Yeah.
So, and you can pool resources, you know, those type of things. It's interesting. You get over 100 units, and that's where you can kind of hire full-time staff to be on site.
Yeah.
And then if you have, you know, smaller ones, it's this middle range, you know, from that 30-some to 90. Yeah. It's hard because, you know, even some property managers, we can't do it for you, or you have to partner with another, you know, local one because our facility, you know, they just can't, because so it's kind of you have to solve a problem in that I'll call it a sweet spot, because that allows the little guys, you know, and not big institutional investors that, okay, yeah, we'll get this 250 unit. We have on-site staff. We got 2 handyman. We got, you know, a leasing agent and all that stuff. Well, we don't have the, you know, you can't, the property of that size can't, you know,
I see like that. One maintenance guy. That's really good.
Yeah, for sure. That really is a must. Put it that way for sure.
So go ahead.
No, I was just going to say, so how many units are you at right now?
Like that I own only by myself?
No. It's like, how many are you involved in?
Yeah.
Oh, well, so I'm in syndications too.
Right.
So I would say, go by doors, I would be invested in multiple hundreds of doors.
Yeah.
Okay.
Locally here, I've only got a couple properties basically.
Sure.
But,
And what really intrigues you with syndications?
okay, it's a good question because the way I look at it is I'm still working a W-2, so
Right.
and I travel some for my company, so I'm out of town for a week at a time maybe or so, and so you're doing all this stuff, outside of core hours, right?
Yeah.
And I like a syndication because I don't have to be pouring, tons of hours and time into that, and
And the headaches that come along with it. Yeah.
What it does, and as I was mentioning, what I did is I diversified. So because the LLC, did very well, we made over 2.5 million. And once again, man, it was so great. Giving investor checks. Yeah. Oh, it makes you so it just made me so happy.
They're like,
I'm like giving away money. It feels like, it wasn't mine, but I was like, this is so neat because it like changed lives almost,
Yeah.
So I was trying to underwrite deals. So I'd look at a 11 unit, a 20 unit. And because of the time frame that it was, when we sold, interest rates are ticking up. They're in the 5s and the 5.5. We probably sold just on the other side of peak. Okay. But we got peak because it was a cash offer. Right. It would have been, if we would have started 2 months, and it's not like we planned it. It was like, hey, we don't need to sell. We were going to hold for 10 years, right? Yeah. But the market changed. So now I'm underwriting deals and I'm going through my spreadsheets and I'm like, they want 1.2 million for this
6 unit.
And I'm like, I'd like to be at 750. I could maybe stretch it to 9. And they're like, oh, we don't want to go. They're at 1.4. We don't want to go less than 1.1. Yeah. And I was running into that on all these things.
That's
so it's like,
at, honestly.
Yeah. So I did a little shift like, well, I have some capital now to work with. Mm-hmm. Let me look into this. So, and I had I'd actually done one syndication before that. But what I did is like, okay, these operators are getting deal flow. They're in a certain region of the country. Let's call it Texas, first place, right? Yep. Huge influx of people. They've got 250 unit apartments here, all over Houston, Dallas, wherever, right? So, and then they have broker relationship and contacts. The brokers are calling, hey, we've got this. We know you close. We know you're going to do it. They're putting up, sometimes they're putting up, could be $1 million. If they're buying it for $24 million or something, they're putting up $1 million hard money because they know they can close. They know they like the deal and everything. And you're like, whoa, they're going to give me, earnest money, hard money of $1 million. If they back away, what's the, right?
Yeah, can't lose.
So I looked at, so what I did was I diversified across various operators in various parts of the country. So Dallas, Phoenix, Nashville, multifamily, Tampa, Florida. And then
those are great markets.
So, right. All market and some up here too, and operators. So if one part of the country gets hit with whatever, or hurricane or Florida, or, a tornado or something. Anything. And you have issues and things. Well, okay, I've got a portfolio that has some other areas. Yeah. And then I was saying I diversified across other alternative assets. Right. So not just multifamily, although I think it's great. Right. I'm in a car wash fund in multiple states. So it's real estate and a business on top of it, a mobile home park fund. So they have, where that's higher cash flow. Yeah. Was a golf course and wedding venue. Wow. So, so that's a different niche. That we're in, a truck wash in Texas. So it's like one of the only ones
near it all.
Yeah, honestly.
But if I was going to do that, I say, okay, now I have to spend, all those hundreds of hours of research and understanding. Okay, and we talked about self-storage earlier before we started. It's like, okay, I want to get in well, am I going to spend, all these hundreds of hours and years learning this to do it right? Or here's somebody that's been doing it for 30 years. Yeah. And they have a track record. I'm going to do my due diligence on them. I'm going to look at this and go through I'm going to do the due diligence on the deal too. Yeah. right? Make sure everything's in line. Talk to previous investors. Okay, if I can invest with them. Now, if you did it on their own, could you earn a higher percentage? I'm going to most likely say yes.
Yeah.
But you've got all that added just stress and things. So if they can give you, call it a 18%, internal rate of return, and maybe a 21% average annual return, and they're taking fees, and that's good. They got to create. They have staff. They got to manage it and all that stuff.
Of course.
I think I'm going to be pretty happy with that, right? Because then I don't have to pour all that time into that. And I can still stay focused. I can still look for multiple. That's kind of what I know as well.
I didn't look at it at that perspective because we always been like kind of against syndications because we were like, we want 100% ownership or at least close to 100%. But looking at it as like the time and the stress point of it, it's like, you take my money, you make it work for me. And I just see that money coming to my account.
Yeah.
All right. So how did you go about finding all these operators across the country?
So some of it would be from referrals. A lot of them I heard on podcasts and then reached out. I am in part of a mastermind group too that I bounce ideas off, and then they bring in speakers and you talk to people. So there's kind of a group of it's out there. There's just everything's out there. Yeah. So, and then once you kind of are in the circle, you start going, oh, I see where all these pieces fit into place.
Okay.
So that's the way I went about doing that, because
mastermind networking a little bit.
Yeah.
Facebook groups.
There's some Facebook groups as well. Okay. But I for some of these I've met some of them in person too. I haven't flown to, I don't fly to the location, of the thing. Some people would potentially do that too.
Just to see what they bought.
Yeah, as well. If you're in an area, I've talked to them or something. But so if you have a relationship or you develop a relationship with them, probably it starts over the phone. You have calls, and then some of them have investor relations too.
Have you been out to Chad's winery yet?
I have not.
No? We were thinking about taking a trip down there at some point soon.
Yeah, and because I'm an investor, I can go to they usually have a one day or a night at a day, kind of a conference. It hasn't been right to be able to go out because I'm invested in, like I said, one of their, it's their golf course and wedding venue, one there.
Yep.
Yeah, so in New Jersey. So it's...
No, that's super cool. Yeah. That's definitely something that we should dip our toes in eventually once we build up some more capital. And when you are investing into, these syndications, what's the bare minimum for the capital requirement that you tend to see? Yeah,
so that'll depend. On the operator, it depends sometimes on the asset, depends on how established, how much or how they need money.
Yeah.
I would say a good average is $50,000 as a minimum. Some of them will be 75 or 100. Once in a while, you'll get some, at a 25,000 minimum.
Sure.
And as you guys mentioned earlier, probably 75% of them, you need to be an accredited investor.
Yeah. So are you accredited?
I am an accredited investor.
Gotcha.
With the help of, the deal too.
Yep.
So I was able to leverage, all that for these. And it's kind of like a whole new world is opened up to you.
Honestly.
It's what it so much to learn. And I was going to ask, for the second deal kind of, for that multifamily of $2.5 million, did you take an acquisitions fee?
We did not.
Okay.
And then we didn't do that. There's a couple reasons.
One, I think to help build trust, probably.
Yeah, we're talking about this is our first deal and things like that. Now I probably, if I did a bigger deal, I could take an acquisition fee because we actually fronted funds. We had to do different things and due diligence, and it's not like $750 to do due diligence, right? It's thousands of dollars.
That's a lot.
And so we're taking all the risks up front and things. And did I know about acquisition fees then? I did, but it was you're kind of
not there yet.
Yes, exactly. And then disposition fees and refinance fee. So it was basically a really clean. Here's what you get. You get 8%. We're going to pay you, and then we're going to pay. When we sell.
And now you build the trust of those people.
Absolutely.
Now they have more capital to even invest in future deals that you could possibly have. So it's just all about building that good relationship, the good rapport, and continuously building that trust over a period of time.
It is. And I feel like I want to help people do that because so many people don't know about this at all. Yeah. All they know is the stock market.
Right.
So, in getting to learn this, I actually partnered with an operator, in Q4 of last year to raise funds for them.
Okay.
And so I established kind of another LLC, reached out to my group or, have an email list and different people to raise capital for them. But because I could so these syndicators will see like, hey, here's the $50,000 minimum. Mm-hmm. And if they're raising, say, $18 million, that's a lot of $50,000 people, right?
That's a lot.
So if you can come and say, hey, I can bring a bigger chunk of money, they're going to say, great, I'm going to give you a little bit better terms for your deal, right? So typically, depending on, and then, you could, if you were, independently wealthy, you could say, oh, I'll just get in that class, give you more money and get a better deal, right? Yeah. That's not where we're at. So normally you would get that they call it a 6 to 8% preferred return.
Right.
And it just means that you're not guaranteed, but you will get that 6 or 7% before the operator takes any money out of the deal for themselves. Okay.
It's almost like a guarantee.
Yeah. I mean,
as long as
except they're not guaranteeing you that money. And if they screw up or something happens with the property, or they got a bad bridge loan and now rates are topsy-turvy and now it's not worth as much,
defaults a little bit.
Right. Yeah. So 6 or 7 is kind of the norm. And then when I raised funds, I got an 8% preferred return because I was bringing a bigger bulk of money.
Yeah.
Typically then you're getting a 60 or 70% split, 60 to 40 or 70-30. Investors get the bulk of that.
Sure.
But with my fund, because you're bringing more, I was going to get an 80% split with it. So
that's awesome.
Yeah, that was neat.
Yeah.
Because you're bringing more capital, they don't have to deal with all these people, and they don't have to go out and raise the funds and figure out where they're coming from, because you're kind of a liaison for them.
Right.
So the fund that I did for that got better returns. And in doing so, I'm able to expose people to it. And then, I can take a fee on the back end, kind of at the end where, there's a split at the end, and I can take a split. And the investors are still doing just as good, if not better, depending on how things work out than if they invested directly with the operator.
Right.
And I was able to kind of tweak my minimum a little bit down to that $25K to help, some people get in too that typically didn't even know or wouldn't even known about, these type of things.
Right. That's awesome. You're just helping out so many people like this.
It's just like if people knew, and
it is.
And somebody would say, like you said, high risk, high reward. Mm-hmm. But in reality, it's a real asset, right? And as a syndication, you don't technically own the asset. You own a share of the LLC that owns the asset, right? So you're kind of one step away versus if you were actually on the paperwork of the house that you own. But if you go and buy a REIT on the stock market, I mean, you're probably 7 steps away, and all along the way, each person took a fee in that.
You're just getting that small percentage at the very back end.
And essentially, it just floats with the market, so it's not even really tied to the real estate. So what I like is that this is a hard asset and people are going to need to live somewhere,
of course,
no matter what happens, right?
Never going away.
Yeah. So that's what I think is so just base and core about that, and that just brings that risk way down, assuming, you've got insurance for what you have, right? You account for, okay, when I buy this, taxes are probably going to go up. Okay, I've accounted for a 50% increase in taxes. They only go up 25%. Good. We have a little cushion, right? So that's why I like to look at the underwriting of what those operators do too, as well.
If we ever get presented with a syndication deal, I'm bringing it to you first. I need you to look at this thing.
Yeah, well... In my email box, I get tons.
I bet. So when you're investing into one of these syndications, what's the typical payoff? Like, what's the period of time you're looking for? Is it 1 year, 5 years?
Yeah, so these are longer term investments. You're not looking at a 6-month window, right? They'll say a 3 to 5 year or a 5 to 7 year, right? Okay. Actually, one of the accountable equity, the golf course and wedding venue, they're more like a 15, 20 year.
Oh, wow.
But that is they have so much heavy construction and things and getting it up. So it'll be 3 to 4 years. They'll do a refi, basically give you back all your money and then just hold it. Right. So what else? So essentially it's, infinite return because they've already given you back your money. So time value of money, velocity of money, you get that money, you go put it somewhere else. Now that money is still going here. And right.
Wow.
Okay.
Yeah. So, I mean, these are not like 6 month, like, okay, I'm going to do a hard money loan and out for 6 months, or I'm going to do a private loan for, 9 months or something on a house flip. I mean, you're talking about, 5 years is going to be it. But if you think this is a good rate, you can think you're going to beat, that rate in the stock market. But I mean, even in mutual funds, 8% is the average. But I can show that, from
what would you say your average is?
My average from
your return?
Never even. Well, if you include this deal in it, I guess awesome.
We're not including that one. It's like strictly the syndications. It's like, what could a typical investor expect?
So, a typical syndication. Let's just use easy numbers again. Let's use $100,000 because it's easier to think about, right?
Yep.
So if you put in $100,000, typically on a multifamily, you're going to get around a 7 or 8% cash on cash, or the preferred return, right?
Gotcha.
The first year they're going to give you 4 to 5%. The second year they're going to bump it up to 7% because they're using that capital. Same thing. They've got CapEx. They're renovating properties. They're doing value add. Typically, a lot of them are doing that. These aren't like Class A top of the line because they're kind of there, and that's where super institutions that can borrow money at 1.5% are buying those, right?
Of course.
So these are value add. So you're looking across that, and then essentially you get part of the upside then as well from that equity split at the end. So I would say anywhere from a 1.9 to a 2.2 equity multiplier. So you put in 100,000. I'd say roughly in 5 years, expect to double your money from the distributions and the sale of the asset.
Yeah.
Now, is that going to make you super rich? Well, no. But if you can keep,
Doing it multiple
right,
times.
and then on like this other one, what if you're in one and they do a cash out refi and you get 80% of your money back, and now you're still getting paid out? You take that 8% and use that somewhere else.
Yeah.
That's really good. In good times, some of these syndicators have disposed of properties in 11 months, in 13, 15 months in the prime time, and cycled through that.
Yeah. That's amazing, especially when the people who are investor are making 100% on their money. That's crazy.
Yeah.
That's
and
really crazy.
you're not at the whims of the stock markets up and down. I mean, there's good companies out there, but it's not, they're trading at 14 or 17 times,
on a good year.
Yeah.
On a good year.
And these, it's based on the property value, and if they're running the property well, and there's not going to be these fluctuations and things. Now, cap rates will move a little bit with mortgage rates and the market and things, but the demand's going to be there. And if they forecast something that's conservatively, underwrite it conservatively.
Sure.
That's what you're looking for there.
Now, with the properties you're finding, are they all through brokers, like on the, commercial MLS, or are you finding off-market stuff as well?
Mainly the pocket listings, right?
For any of these, I mean, if I'm looking at a multifamily, you mean?
Yeah.
I'm looking on, some brokers have brought me stuff.
Yeah.
I'm also looking on Crexy, some of these different things too. But it's, like I said, it's hard, right? As you know, the underwriting, I just can't
seem to pencil out anything.
I can't get the buyer and seller to meet, you know? It's
too
exactly
big of a gap right now.
Have you thought about doing any creative financing?
I have, and even, I'll tell my daughter when she's looking too, well, hey, talk about, see if they'll do terms or something, even for a single family house off market, if they need to get a price, figure out how you can get them that price, and by doing, get a better interest rate, no payment for a couple months. And amortization and those type of things. Absolutely.
Awesome. Well, it's been an absolute honor having you here. But before we close it out, I was just wondering, do you have any big goals for the end of the year, or for this upcoming year?
Yeah. My goal was at the end of the year was to try to become financially free. Now, what do I mean by that? That means my passive income is equal to my monthly expenses.
Okay.
Right. So I've been tracking that based on, all right, here's all my cost monthly, and here's all. And I'm about 42% right now of passive income, matching monthly expenses. So
halfway there.
Yeah.
That's awesome.
Yeah. It's
so you're thinking maybe 1 year time frame, you're hoping to get to that 100%?
Yeah, I'm just that's the goal, and I've been looking at some of these other things. When we're in our mastermind, bouncing around thoughts. And of course, we're always got an eye out for
Right, of course.
for deals and things like that. Absolutely.
Yeah, that's awesome. Do you have anything to say?
No, we're probably going to have you on for a part 2 or something in the future, because I feel like we just touched like very little of syndications. There's literally so much we could have talked about.
Yeah.
Diving deep, but I know we're limited on time here. So, but truly appreciate you coming on, Jeff.
Oh, without. Do you have anyone you want to shout out? Any social media links or anything like that?
Oh, I mean, I guess you can follow me on Instagram. Right?
There you go. We'll make sure
Jeff
to leave
Allen
it down.
There
Investor, and
you go. Awesome. She'll be sure to tag him down below.
Yeah, we'll make sure to leave his information down below if you guys want to connect with Jeff, and if you have any questions in regards to syndications. But with that being said, we'll catch you guys in the next one. Peace.